Here we're going to be looking at an example here where we're going to be using the lower of cost or market value here for inventory costing. And what we're going to have here is be looking at an error effect here on our net income, where we're going to be using a wrong valuation here of our inventory. So let's look at our example here, and we're just going to be looking at concentrating on one item here that we have in our inventory, and we have a quantity here of 1,000. The cost per unit here, this is the original cost here of $80. Cost to replace that unit here is $76. The selling price is $100, and disposal cost here is $28 here. That's the cost to complete and the cost to disposal of this item here, and our normal profit here is $18. So the first thing we have to do is we have to, when we're using these lower of cost or market inventory amounts here, we have to determine here first the net realizable value here. So let's look at that here. That's the inventory, that's the sales value here, that it's selling price of $100 less the cost to complete and disposal of it here is $28. So our net realizable value here would be $72 on this unit here. And then to determine our net realizable value here less a normal profit margin here, we would take our profit margin, that was the normal profit here of $18 per unit here, and we subtract that here from the net realizable value of 72, and we come up with our net realizable value here less this profit margin here of $54 per unit. Okay, now we have to determine the lower cost or market value here for this unit here. So let's look at it here. First we have to determine the designated market value here, and that's going to be the middle value here between the replacement cost, this net realizable value that we calculated up here at $72. That is the ceiling amount here. That's the ceiling amount here of $72 that we calculated, and then this net realizable value here less this profit margin here, that's our floor amount here, and that was that less this profit margin here, that was that $54 amount here. So what we have to do is we have to determine the designated market value here, and let's go up and look at what the definition here is on that. The designated market value here is the amount compared to the cost here. It's always the middle value of the three amounts here, that replacement cost, the net realizable value, or the net, or thirdly here, the net realizable value less this normal profit margin. So let's go down here. These are the three amounts that we have to look at, and we have to, in this case, the replacement cost here is the high amount here, and the floor amount here, the net realizable value less this profit margin here, is the minimum amount here of $54. So the middle amount here is our ceiling amount here. That was $72. So that becomes the first thing we have to do. That becomes our designated market value here. That's $72, the middle amount here. And then we have to determine the lower cost, either the cost or the market, market value, whatever that is. So let's look at it. Our cost here was $80 per unit. Our designated market value that we determined was $72. So the low amount would be the market value here of $72. So the quantity here, we had 1,000 of those here. Final inventory value would be $72,000. Now let's look at how this, if we choose the wrong value here, in this case we're going to be, by mistake here, we're going to just take the replacement cost here, and we're going to be using the replacement cost here to determine our gross profit here, and that's the wrong amount. We should be using the lower cost or the market value here at $72. This is the correct amount. We're going to be looking at year 20x1 here, and then also 20x2. And we're going to be going through here in just the income statement to determine our net income or our gross profit here on this unit by taking the wrong amount here versus the correct amount, and then continuing that into the next year here. So let's go over and look at our calculations here. For 20x1, our ending inventory, well, we had 1,000 units times the $76. That was the replacement cost. That was the wrong amount here, the one we shouldn't have chosen, and so that would be $76,000. So our ending inventory here in 20x1, on the 20x1 here, would be overstated here, $76,000 here. And then remembering our ending inventory here in 20x1 becomes the beginning inventory here in 20x2. Again, same amount, 1,000 units at $76 here for $76,000. Again, the beginning inventory here in 20x2 would be overstated here. And we assume that all 1,000 units here are sold in 20x2. Now, the correct amount here, when I say this was overstated, our correct amount would have been 1,000 times the $72, or our lower cost of market value here, for $72,000. So the correct amount here should be $72,000, and we are using $76,000 here. So just looking at it on an inventory per unit basis, we used $76 here per unit. The correct amount here would have been 72, so the difference is $4 per unit. 1,000 units here times $4 gives us $4,000. So you can see we're overstated here by $4,000 for our ending inventory on 20x1 and our beginning inventory here in 20x2. So let's go and look at our income statement here. And then for 20x1, let's just say the wrong amount here was $76. We have just a sales amount. I'm just plugging these numbers in here, $500,000. And then we'd have to calculate our cost of goods sold here. Let's just say our beginning inventory was $357,000, purchases of $119,000. So our goods available for sale would have been $476,000. And let's say our ending inventory here, the wrong amount, $76,000. So subtracting our ending inventory here from our cost of goods available here gives us our cost of goods sold here of $400,000. Simple enough here. Now to determine our gross profit or net income, just the difference here between our sales, $500,000 less our cost of goods sold here of $400,000 gives us a gross profit here of $100,000. Now, had we used the correct amount here, 20x1 here, the $72 lower market value here, the correct amount, you can see here the only thing that would have changed here in this, if it would have been our ending inventory, it would have been, instead of $76,000, it should have been $72,000 here. So you can see we're overvalued the $76,000 here by $4,000. So just doing our arithmetic here, we're going to come up with our cost of goods sold at $404,000 here, less versus the $400,000 here for the wrong amount. And then taking that from our sales, you're going to see our gross profit should have been $96,000. So we're overstated here by $4,000 here in 20x1 here for our net income or our gross profit. Now, let's go up here and look at 20x2 here. Now, the beginning inventory, in this case, the ending inventory from 20x1 becomes the beginning inventory here in 20x2, and it's overstated again. That's what we calculated over there. It was overstated here by $4,000. So let's just say the correct amount here should be $357. I'm just, for example here, I'm using $361, overstated by $4,000. So going through all our arithmetic here and then just taking our ending inventory at $72,000 here. And this is just for comparison purposes here. We're going to come up with our cost of goods sold here at $408,000, and subtracting that here from our sales of $500,000, we're going to get a gross profit here of $92,000. Now, just for comparison purposes, the only reason I'm doing that here is to compare it here with the correct amount here. It should have been $96,000. Here we're sitting at $92,000. So we by overstating our beginning inventory here for 20x2, we're reducing or understating our net income or our gross profit here. So let's just look at what we've done here. If our ending inventory is overstated, which it was here, net income is overstated. So you can see our ending inventory here was overstated, and then you can see our net income or our gross profit here was overstated. Compare it to the correct amount here of $96,000 versus $100,000 here. $96,000 being correct, $100,000 being overstated. Now, if we look at the beginning inventory where it's overstated, the net income is understated. So in this case for 20x2, we say we overstated our beginning inventory here by $4,000, and then all the other items being constant, our gross profit here or net income was $92,000 versus the $96,000, the correct amount. So you can see here we're understated. Beginning inventory is overstated. Our ending or our net income here is understated. So this is just an example. I went through a lot of numbers here, but just an example of how we making an error here and choosing the wrong value here, or not using the lower cost of market value here, how that can affect here our net income on our income statement.